let's get a view from the commodities analyst at Barclays Capital, Amrita Sen. Amrita, very good afternoon.
Good afternoon.
If the oil reserves were to be released, would this really impact the market and bring prices lower?
I don't think it would really do that on a sustainable basis, because just a few months ago when the IEA and the US government did a joint release together of 60 million barrels, really didn't have a significant lasting impact. That's what you would hope from a government point of view. It brought prices down for 3 or 4 days, went straight back up. The reason for that is the oil market fundamentals are very, very tight. I'd add the other thing is that at least last time they came in, they did it quite unexpectedly. This time around, there's been so much talk about it consistently over the last couple of weeks. I do think a lot of it is already being priced in. The latest move down in oil prices, or the very fact that prices haven't moved up, has been because it is now being priced in. It is almost an inevitable that there will be an SPR release of some sort from somewhere.
Well, Amrita, you're talking about a tight oil market, but the Saudi oil minister himself, Al Naimi, says there's no rational reason why oil prices are at these levels. So would you agree with him?
I think, obviously, from a producer point of view, he is saying that he is supplying to all his customers, and that's why he said that there's no rational reason. If you look at just two simple measures, inventories, I know he also alluded to their own inventories being full. They only have 10 million barrels of inventories. That's worth just 1 day of their production. You have to look at global numbers. Global inventories today are 50 million barrels below the 5-year average. That's very tight. Spare capacity, again, different definitions. But on our numbers, we can see around 1.7. Even if you take what he said on CNN, by the way, which was not that long ago, that they can get to 11.8, not 12.5 in 30 days. That doesn't give you that much buffer. And then, of course, you've got Iran, Iraq, Libya. The risks are really, really big. So there is every justification as to why prices are where they are today. Non-OPEC supply has been very poor, and demand, especially in Asia, has been strong. If inventories were building, yes, I would agree that there's no rational justification, but inventories are still drawing.
If you take all of those elements you just mentioned, Iran, Syria, tightness in the market, if there is a shock, how high in the very near term could oil spike to?
Oh, I think you really, I wouldn't even put a number to that. And, we've said that if the situation just continues and there is no resolution, we can easily see averages of $135, $140, which means we would expect prices to hit 150 this year, absolutely. But, of course, the situation has to deteriorate significantly. What is putting a cap on those prices is, like we discussed, it is the SPR or the potential for some kind of strategic reserve release. And, of course, the Saudis kind of continuing to maintain production. What I will say here is that the market is very close to the point where it becomes more worried about Saudis producing more and therefore reducing spare capacity. So therefore, yeah.
Amrita Sen, Barclays Capital, thanks for your time.